Hello everyone, welcome to NAB Australian RMBS and Non-ADI Markets webinar. I am Takeshi Nagata, Director from Fixed Income Sales Team at NAB Japan Securities, and I will be your host for today's webinar. We will be starting our webinar today with a welcome remarks by Janari Tonoike, Country Head of Japan and Head of Markets Asia, followed by our three speakers' presentations, and finally, we will be addressing all the questions that come in at the Q&A session at the end of this webinar. Please feel free to submit the questions you have anytime during the webinar session via Q&A button on your screen. I would like to address this again in Japanese for our Japanese audience. 皆様、NAB 豪州ノンバンク RMBS 市場ウェビナーへようこそ。本日進行役を務めさせていただきます NAB 証券フィクストインカムセールスチームダイレクター永田です。本セミナーは NAB 日本代表および NAB マーケット部門アジアヘッド殿池ジャナリのご挨拶の後、3名がプレゼンテーションを行います。プレゼンテーション終了後に Q&A セッションが設けられています。お客様のスクリーンにございます Q&A ボタンよりセミナー中いつでもご質問いただけますのでご自由にお使いください。Now I would like to pass the floor to Janari. Janari, please.
Thank you, Takeshi. Thank you and welcome to all our clients who have joined the Australian RMBS webinar today from Japan, Hong Kong, as well as Singapore. I'm Janari Tonoike, Country Head of Japan and Head of Asia Markets for National Australia Bank. The Australian securitization market has become an important tool for Asian investors over the years, and the region has also become a very important market for NAB as an issuer and also for NAB's issuer clients. Volume allocated to the region is growing, and over the past few years, we have also seen yen-denominated issuance coming to the market. We believe that the non-ADI issuance will continue to be a very important sector for the Australian securitization market. In fact, since 2017, we have seen more issuance from non-ADIs as opposed to the big four ADIs, which also includes NAB. In fiscal year 2021, the ratio of non-ADIs to big four ADI issuance volume widened to more than 10 times, with non-ADIs issuing as much as Aussie dollar 25 billion. The non-ADIs issuance volume itself has also grown 10 times over the past same 10 years. With this in mind, we are honored to host this webinar today with focus on the non-ADI sector of the market, which has increased interest from Asian investors recently. We will hear from NAB's own buy-side analyst, Ken Hanton, as well as Stephen McCabe from the Origination team. We also have Natasha Bojodik, our special guest from Fitch Ratings. Without much ado, I will pass on the floor to Ken. Ken is a specialist in Australian securitization analysis with over 15 years of experience in this area. Over to you, Ken.
Thank you, Janari. Hopefully my screen is now being shared. I believe it is. Janari's right. Thank you for joining us at NAB on this call today. Janari is right. 2021 is going to turn out to be a record year for the Australian RMBS market and ABS market, as it would turn out. The issuance year to date to the end of October has been $34.9 billion, and that's come from 38 public deals. This is up from 2019 and 2017's $28 billion deals, which came from 30 deals in 2019 and 35 in 2017. I don't think there's going to be too much more issuance to come in 2021. So I think this year is going to turn out fairly similar to 17 and 19. But I think it's fair to say that over the last couple of years, the market's evolved from being circa 20 to $30 billion a year market into a 30 to 40 billion a year market. The next slide, sorry, I've gone to. The next slide, which is on page 3, shows bank, or ADI, which stands for Authorised Deposit Taking Institutions, issuance versus non-ADI issuance. My colleague, Dr. Stephen McCabe, will be presenting a chart similar to this one later on, so I'll be brief. But the key points from it I'll make are, post-GFC up until 2017, the market used to be dominated by bank issuance. Now it's not. For the last 5 years, there's been strong and consistent growth from the non-ADIs, whereas the issuance from the banks or the ADIs has been more variable as it's been contingent upon broader market conditions. Why is that? Because the banks or the ADIs, they don't rely on securitization for the bulk of their funding needs, whereas the non-ADIs do. 2021 has seen $10 billion of issuance from the ADIs. This has actually only come from 9 deals, and Macquarie has, in one deal in July this year, provided $3.8 billion of that issuance. Non-ADI issuance, on the other hand, has been just a touch under $25 billion, and it's come from 29 deals. I expect there'll be more issuance to come from the ADIs in 2022, but how much more that's actually hard to predict as it will be contingent on market conditions. The non-ADIs, on the other hand, their issuance will probably be similar to what it's been in the last couple of years. It could be a little bit higher, it could be a little bit lower, I don't know. But what I am confident on is there'll be much less variability in the issuance from the non-ADI sector as there will be from the ADI sector. The next slide shows the distinction between prime and non-conforming issuance from the ADI sector. The difference between the two is can be summarised as prime issuance is issues with pools that contain loans that meet lenders' mortgage insurance criteria, whereas non-conforming deals, they either are wholly or they have a mix of loans that don't meet lenders' mortgage insurance criteria. The main reasons for that is the borrowers may be self-employed or they may have past records of prior defaults. Last year, it was fair to say that there was a lot of concern in our market that as a result of low interest rates and the banks receiving 3-year money at a rate of 10 basis points from the RBA's term funding facility, that was going to creating an unfair pricing advantage on the banks, where it was making it very hard for the non-ADIs to compete. And as a result of that, that was going to push them more into non-conforming originations. And you would see that reflected in our securitization market. As this chart shows, the black line's been above the red line for a number of years now. And in 2021, the non-ADIs in the prime space have really they've had a lot more issuance than non-conforming issuance. So I think those fears haven't come to pass. And I suspect as interest rates begin to normalise, at what rate it's difficult to tell, but as rates begin to normalise and mortgage rates rise, which they actually currently are in the fixed space, I think you'll find those concerns circling the market last year will probably subside. The next slide, which is on page 5, shows primary market pricing of the most senior note of prime RMBS deals. The grey line, which I use in this for ease of visualisation, shows major bank 5-year spreads, 5-year floating rate spreads in the secondary market. You look to January 2020, and if you use that and look to the right of that, you can see the COVID outbreak in early 2020 basically resulted in the RMBS market freezing up for a short period of time. So what that meant is the dots, which represent new issues coming to market, they dried up. When it did open, when the market did reopen, I should say, in early May, non-ADI spreads had gapped 20 to 40 basis points wider than they were pre-COVID. I think it's important to state or mention that this reopening was underpinned by the government, or the AOFM, Australian Office of Financial Management, is the agency that provides the support. Their support buying new issues and secondary issues into the market, as well as providing warehouse support initially. I use the word initially because it's worth remembering that the AOFM only bought notes in the primary and secondary market to support the RMBS market, but only a 3-month window, which was between the end of March to the beginning of July. So the contraction that you've seen in spreads from April to the beginning of September this year, the AOFM was only in the market for a short period of time. I think it's fair to say it's a statement of fact that the credit quality of most of the pools of non-RMBS has been resilient to the impacts of the COVID lockdowns that Australia experienced. And I think it's also fair to say the structures of all RMBS have actually been resilient to the COVID impacts on the mortgage market. Tighter spreads wouldn't have been achievable without these strengths. However, it's also a fact that they've been largely driven by central bank monetary accommodation, system liquidity, or should I say an excess of it, and falling yields. Over the last 3 months, from the beginning of September, we've seen RMBS spreads again gap around about 20 basis points wider. We did have an announcement on the 10th of September that Bank CLF, that stands for Committed Liquidity Facilities, so contingent liquidity facilities, would start amortising to nil over the course of 2022, and that would result in less bank participation in the RMBS primary market. It will not result in the banks being completely absent in the market, though. They will still continue to buy, just probably not at the same volumes that they have done previously. I think it's fair to say this had a marginal impact that pushed spreads wider initially, but the main impact we've seen from this 20 basis point recent move, again, that's largely come from the back of the volatility seen in the global bond markets. Within the Australian context of that, we've had the RBA's 10 basis point yield target abandoned. There's become a widespread view in the market that our quantitative easing program will be disbanded sometime in February or shortly after. And with an inflation story that's been stronger than expected of late, we've also now ended up with a market that's pricing in the RBA coming in and lifting the cash rate from the middle of next year, I should say, whereas the RBA is still communicating that its thinking, or its base case scenario, is that 2024 is more likely, or the second half of 2023 is a more plausible or is a plausible outcome. So I think these global and going down to Australian specific issues around what happens to yields, they're going to be the driving forces that continue to drive the RMBS spread direction, at least in the near future. The next slide, which is on page 6, this is where NAB's indicative pricing of RMBS is in the secondary market. I say indicative because it's not always a liquid market. The chart on the left-hand side shows secondary markets by issuer category for senior prime notes. The chart on the right-hand side shows the same, but for Big Four RMBS and non-ADI RMBS, and they are the red and the blue lines. And I've put those into the same chart with Big Four 3-year and 5-year floating rate note pricing in the secondary market. as you can see, what happens to RMBS spreads is very much aligned with what happens in the broader credit markets, and you can see that in the pricing of the floating rate notes. Going back to the left-hand side chart, you can see that it impacts RMBS pretty much equally. The relativities between the categories stay very much consistent. So your view on where RMBS pricing goes from here it really depends a lot on where you think other credit markets are going in relation to what's happening in the world. And for now, it's very much an inflation yield story. Slide 6, which is on page 7, which is what to look out for slide. I came up with 4 bullet points that I thought were going to be important in 2022. And I should mention that the ASF, the Australian Securitization Annual Conference, is next week. As it was last year, it's going to be held in a webinar format, so I would encourage you all to dial in, especially given the 2 presenters that will follow me today will actually be on panels. So when I was thinking about the bullet points on this, as luck would have it, 3 of those bullet points are now going to be covered in the panels that come up next week. So that's why I'd encourage you definitely to join in on the conference next week. On the first one, reiterating what I said earlier, the RMBS market really has evolved from being a bank-dominated one to one that's more balanced with a broader selection of non-ADI issuers. I think moving forward, we could see some continued volatility or variance in the issuance from the banks or the ADIs, but the issuance from the non-ADI sector is definitely going to be a lot steadier. On the pricing front, again, it's really going to be driven by system liquidity and yield conditions. And now the concerns over is inflation transitionary or is it permanent? I think that's going to be very important in terms of driving the pricing of this market going forward. From where I sit, I think the inflation risks are definitely real, possibly not as extreme as the markets are currently pricing, but from a broader credit market perspective, I think it means that yields are more likely to rise than contract. I think it's hard to see them contracting at the moment. So my RMBS spread view is that spreads will probably go wider from here is simply an extension of that broader macro view. It's actually not driven by any credit concerns or any structural concerns on the RMBS product. The macro Prudential piece, which actually is not one of the topics of the conference next week, this is coming back into vogue in the Australian loan market or loan environment, I should say. We did see a reintroduction of macro-prudential a few weeks ago when APRA instructed the banks to increase their loan serviceability assessment buffers from 2.5% above the lending rate to 3% above the lending rate. The impact of this, what seems to be a small increase, is that lenders now need to assess a new borrower on their ability to repay their mortgage on an interest rate that's double what they're going to be offered. That sounds, well, it is conservative, but I think it's also realistic in terms of what interest rates could do. But I think what interest rates could do over a couple of years, it wouldn't be a sudden shift that borrowers are going to see their mortgage rates double. Moving forward into 2022, if the economy recovers and performs as most expect it will, and credit growth remains strong, or at a multiple of where income or wages growth turns out to be, I think there's a pretty good chance that APRA will come in at some point and impose debt to income and loan to valuation constraints on the banks in their new lending activities. I suspect it will be implemented at a portfolio growth level rather than an individual borrower level, but I do see that as a realistic possibility. For debt investors, I think the added safety ends up being a positive for them. I think for equity investors, the share price has been very much driven on earnings growth and dividend growth. I think it's easy to reach an alternative conclusion. And on the final bullet point, which again is a panel at next week's conference on benchmarks, we're going to see the end of LIBOR. It's a reality that we're going to see the end of LIBOR for pricing of new debt in 6 weeks' time, the 31st of December. In the Australian context, we're going to maintain a multi-rate approach. BBSW is going to remain as an effective benchmark as of the 1st of January. I think it's going to remain a very effective benchmark for 90 and 180-day tenors, and that's on the basis that BBSW has good liquidity in that for those maturities, because there is a healthy balance between banks borrowing and investment of those tenors. Other BBSW maturities, there's not as much liquidity, and in terms of the 1 month BBSW profile, banks don't borrow 1 month money from the market anymore, so it's not really considered to be a liquid benchmark. However, the securitization market, I don't think we see the end of 1 month BBSW as the benchmark as at the 31st of December. I think it's going to continue for a while, but I do think a shift in time to a compounding AONIA rate, which is where the rest of the world will go, I think, with their product. I think the Australian dynamic is it's inevitable we'll follow the global trend. So with that, thank you very much for your time, and I'll pass it back to you, Nara.
Tag, you're on mute. Tag, please unmute.
Thank you, Ken. Next, we will have Stephen Maccabee from NAV's DCM team. Stephen covers vast array of issuers, especially in the non-ADI sector. Again, please feel free to submit your questions anytime through the Q&A button, and we will address them at the Q&A session at the end. Over to you, Stephen.
Thanks very much, Tak. Thanks very much for the intro, and good afternoon, everyone, and thanks very much for joining. Can I just check with one of my other panelists that they can see my screen, okay, so that I'm sharing correctly? Yep, I'll tell you those, yes, thank you. Okay, everyone, so I'm going to spend the next sort of 15, 20 minutes probably talking to some of the same points that Ken discussed. Not because we didn't look at each other's presentations, but because we think that they're very important points to cover. But also I want to drill down into who are the key non-ADI issuers in the market and what is their differentiation in terms of product. So over the next 15 minutes, my aim is to cover these sort of four topics. Really want to give an overview of the Australian non-ADI issuers, looking at the asset classes, having a look really between the key differences between the two issuers, and also noting that there is there's a very different deal structure between them. So from a securitization RMBS type perspective, the two types of issuers have very different deal structures, and that's sort of driven by the fact that the collateral is generally very, very different as well. So moving on to who are the issuers. So these are the key players in the market. And what I'll do is I'll just give you my own personal view as to who these guys are. So you've only really got like a handful, as you can see. And as Ken said, they did issue 29 deals last year with a significant amount of volume. Starting at the top, so AFG is probably more widely known as one of the brokers. The broker network is the primary distribution for all mortgages in Australia. I think 60% of all mortgages are distributed to the end borrower via the broker network. And if you think about the non-bank sector only being sort of circa 7 or 8% of the market, it means that even the likes of NAB, a CBA, a Westpac, etc., are still actively using the broker market. So AFG is probably the biggest broker network, and they have their own funding arm there. So to the extent that they can offer product and distribution, they see that as a great synergy between the two. Reasonably new. I think we've only really seen them issue in the last couple of years, and deal size at this stage is still relatively small. I'm not going to go through every single one of these, so I'll just pick some of the highlights. Athena, again, are a very new entrant to the market. Athena act at the super prime part of the market, so they offer extremely low rates. And the idea behind their originations is it's super high technology and super efficient is the idea. Again, very new. I think they did their first deal this year, but I would expect to be seeing them as a very regular issuer. Almost at the other end of the credit curve is Bluestone. So Bluestone traditionally are very much a non-conforming lender, so very much looking at people with very much impaired credit histories, people that have had divorces, illnesses, or lost their jobs. Bluestone very much originally targeted that part of the market, but have subsequently moved up the credit curve more into the prime. Columbus Capital, I will give them a mention. Again, a prime issuer. They also have quite a diverse set of collateral. So Columbus Capital, one of the biggest issuers of self-managed super fund loans. So these are loans where, as part of your retirement, you can invest in an investment property for basically to get a capital gain over the life. So it's very much targeted at retirement, the people who are sort of saving for their retirement. So Columbus Capital very much heavy in that self-managed super or SMSF space, but also they do a significant part of non-resident lending here, which is like loans to non-Australian citizens. First Mac very much at the prime part of the market, so reasonably big issuer and very much sort of competing against the main banks. Latrobe very similar, Liberty very similar. They both have sort of prime and non-conforming. I'll skip Mortgage House and move to Pepper. Pepper and Resimac are the two biggest names. I think if you are aware of any sort of non-bank issuer in the Australian market, Pepper and Resimac will be those names. Pepper traditionally were a non-conforming lender. They moved into that prime space and also have an asset and equipment finance arm as well. Resimac, very similar. They have non-conforming programs, they have prime programs, and from the next slide I'll show you, we're actually the most prolific issuer of the year. The only other one I'll mention is Think Tank. Again, reasonably new entrant to the market. They've been focusing on SME type deals. So this is effectively you have a mortgage over a dwelling, which is usually above some sort of commercial space like a shop, and very much that is viewed as a commercial mortgage, the package. So, but a small ticket commercial is where Think Tank have historically been playing, but they're now moving into the much more consumer space. So that's my very brief overview of the key issuers. How has that issuance looked over the year? Again, reverse order by issuance volume here. So as you can see, Resimac and Pepper have both done 6 deals this year across both of their programs, the prime, near prime, and non-conforming. Just to be clear, and I'll talk about this on the next slide, Near prime are assets where they're not quite prime, so they don't quite fit in to the lender's mortgage insurance criteria, but there's actually nothing wrong with the credit quality. So these are not borrowers who have had a life event. These are not borrowers who are bankrupt. They're not borrowers who have missed a major payment or have defaulted on a mortgage. They are typically borrowers that can't get prime credit for other reasons, and I'll talk about that next. But just to be clear, when in Ken's chart on the previous one, when he's talking about there being $10 billion of non-conforming collateral, that non-conforming collateral typically utilizes a lot of this near prime collateral. There's certainly not $10 billion of people that have very bad credit histories in Australia. First Mac and Columbus clearly sort of round out the top four. They are probably the four big ones, with Latrobe and Liberty sort of up at the heels. And then you can see the other ones are quite sporadic, with Brentford AFG, Bluestone, and Athena's first deal there was a small one. As you can see, very highly concentrated. So those top four, or top five, I should say, represents or circa 73%. And for the purposes of this, we are looking at collateral here. So the issuance volume has been predominantly in Aussie dollars, but we've also seen the resurgence of US dollar issuance and the resurgence of yen issuance as well. I think back sort of pre-March 2020, just before COVID hit, there was quite a large issuance program, certainly in US dollars and yen. But following COVID, a lot of that has dropped off. We're now seeing sort of a trickle compared to what we saw previously, it's quite sporadic issuance. I think most of the US dollar issuance would be from, for instance, Resimac, and it would be probably from the last two deals. Moving on to the next slide. So this is a slide that Ken's sort of shown, and I think that to me this really raises a very big question. This is the answer to the question: why are non-banks so important? And I think you can see there in red, that's the non-bank issuance. And again, it's really taken off from 2017. I think from sort of 2016 and before down to 2010, it's sort of similar, or if not dwarfs in comparison to the ADI issuance. But since 17, clearly been knocking the lights out in terms of issuance. Just a couple of points just to reiterate from Ken's talk. I think one of the reasons in more recent years, or 2020 and 2021, we haven't seen a lot of ADI issuance is because they had alternative funding arrangements. So they could access things like the term funding facility, whereas the non-banks effectively only have access to one real main source of funding, which is securitization markets. And then that's probably one of the big differences between them. So non-bank issuance has been sporadic. Maybe another question would be, why has there been any why has there been any ADI issuance at all? If you can borrow from the TFF at, say, 10 basis points, why would you go to securitization markets even if they're funding down at sort of 1%? And part of the reason behind that question is some of the bank issuers, the ADIs, are looking for capital relief as well as funding. So there are some capital benefits, but also the likes of Macquarie. They actually their originations were very, very strong and remain strong, and they actually burnt through their allocation under the term funding facility. So saw a window and pounced on that window, and as Ken said, did a $3.8 billion securitization, which is effectively a large proportion of that 2021 bank issuance. So the fact that the non-bank sector is a very frequent issuer, for instance, the likes of Pepper will be issuing every couple of months, Resimac similarly, they really do form the backbone of the Australian securitization market. So moving on to product. I think we've talked about prime and non-conforming, and I think those are quite simple. So another way of talking about a prime loan is it's a loan that someone like a NAB or would write. So it's so anyone who's competing in that prime space is really competing against the likes of NAB, Westpac, CBA, etc., etc. It's someone with a very clean credit history. It's someone who meets certain criteria, and very much from a big four, big ADI, it's very much a cookie cutter process where you get a big stream of applicants in, and to the extent that they meet certain criteria, their loans are approved. At the other end of the spectrum is the non-conforming guys. So these are guys that have had some sort of life event typically. So, borrowers that would have been a clean credit, but have had some illness or lost their jobs or had a divorce or something and have had a major default. And we're not talking, a fine for a book club where they forgot to pay the book club fine. It's more that they have had an auto loan or a mortgage or something very relevant, and they have had a very bad black mark on their credit history. Typically would have a very low Equifax score as well, so sort of sub 400 in Australia. Now, these guys, there is a market out there where usually these guys, it is a one-off event and something has happened, and there are issuers out there, the likes of Bluestone, Pepper, Resimac, etc. These traditional non-conforming guys who do a lot of credit work and try and establish if lending a loan to this person to purchase a house is a good thing in terms of rebuilding their credit history. And one of the things that a lot of these non-conforming lenders have is a sort of a program where once the lender has had, say, 2 years of being able to pay their non-conforming loan, then no longer technically a non-conforming borrower because they've got their history back, their Equifax score has gone back up, and so they can actually move into much more of a near prime or a prime borrower, and would obviously be looking for a lower rate. Probably worth mentioning, obviously, non-conforming interest rates are very much higher than prime rates. Now, the interesting one from a product perspective is this near prime category in the middle. And then just to reiterate, we talk about, in terms of funding, prime and non-conforming. So non-conforming covers both the near prime and the true non-conforming guys. So a near prime borrower would be someone that doesn't meet the criteria for prime, but typically it's not reasons because of a credit event. So for instance, I'll give you an example. One of the criteria for a self-employed borrower to be prime is that you need to have been in your job for 12 months. Now, you might find that there's a borrower who has been working for NAB in their IT team, for instance, for 10 years, who has subsequently set up their own company, is now doing the same thing, but technically cannot be a prime borrower. So they would be a near prime borrower. They would because they don't technically qualify for a prime loan, but they certainly have no adverse credit history. So that they sort of fit into this middle area. And I think this is probably one of the largest growth areas in the Australian market. It's the guys that certainly are not eligible for prime clean credit, but also don't have a really bad checkered history. That's where we see the biggest growth. Key differences. So probably the key difference between ADI issuers and non-ADI issuers is the ADI issuers have to obey the rules of APRA, the Prudential regulator, and obviously NAB is included there, whereas the non-ADI issuers do not have to obey those APRA rules. However, that's a slight misnomer because in order for the non-ADI issuers to get to a critical mass of mortgages, they will typically have warehousing arrangements, and those warehousing facilities will be provided by an Australian ADI typically. And NAB is very active in the space and has a lot of warehousing agreements with a lot of the names I've talked about earlier. But obviously, because NAB is regulated by APRA, that APRA regulation does flow down into our wholesale funding relationships with non-ADI issuers. So almost by stealth or by the back door, APRA sort of does regulate these non-ADI issuers. Well, what you do find, however, is when the housing market is particularly hot and very rising at a very strong rate, you might find APRA putting some speed bumps in. We saw that sort of in 17, 18, where there was limits as to what the ADIs could write in their retail book in terms of interest-only loans and investment loans, etc. Now, this was a fantastic opportunity for the non-ADI issuers, because they're now, the major banks cannot write these loans, or they're capped out at those loans, yet they are very good quality. So the non-ADI issuers can step in. And this is one of the reasons, I think, why people typically who are good, clean credit quality would then go to a non-ADI issuer. Again, one of the other real key differences here is in fact, all of the non-ADI issuers very much follow this originate to distribute strategy. So every loan that they write must be eligible to be put into a funding vehicle and termed out. They have very small balance sheets, although some of them do have the ability to sort of use the balance sheet to originate new product. But obviously for the ADIs, they have other sources of income, predominantly customer deposits, but also the likes of NAB and etc. can go to offshore markets, and even domestically can issue senior unsecured and other forms of debt. Probably not going to cover too much of the other one there. I mean, technically, let's talk about risk retention. So because these ADI issuers are originating some significant volumes, and 7 or 8% of the mortgage market is a significant number, they typically need to have term deal structures that are globally have a global investor base. So we would normally see considerable interest in these non-ADI issuers from the likes of the European, the UK markets, and then Japanese markets. And in order for the transactions to be eligible for those investors, they need to comply with the local risk retention schemes. Now, that's the same across both ADIs and non-ADIs. However, given what I've just said about the balance sheets, the non-ADIs don't have a big balance sheet, which they can have this representative sample. So what they typically do is they have a specific risk retention vehicle, which will take a 5% slice of each tranche. And that's why you'll typically see for non-ADI issuers, only sort of 95% of each tranche is actually available. Rating is probably another really obvious one. I don't think I think Liberty has got a BBB rating. That's the only one that I'm aware of that is rated. All the rest of the non-ADI issuers are non-rated, whereas obviously the ADIs are typically always rated. What does that mean? It means that the ADI issuers can perform a number of roles in a securitization. For instance, they can have their own bank accounts, they can have derivative counterparty, etc. And the rating agencies allow them to do that because they have the required rating. Whereas for non-banks, you tend to find that another ADI or the arranging ADI will provide a lot of those sources. So you've potentially got that sort of additional counterparty risk inherent in those non-ADI structures. The last thing on this slide I want to sort of highlight is in terms of origination systems. So a lot of the major banks specifically, they do have these very clunky old legacy systems that need to link into the very, very traditional systems. And that can lead to very, very slow processing times and very un-tech friendly ways of doing stuff. Whereas a lot of the ADIs don't have those sort of legacy issues. They can be very much cutting edge. They can design their system from scratch. They can adapt the system to new products, to new borrowers. The process of applying for a loan with a non-ADI is typically a much faster process than it would be for an ADI, to be honest. Last slide. And I'll call it quits. In terms of the deal structures, a typical non-ADI deal structure, given what I've said there about the ADI not having a big balance sheet and not being able to keep a lot of stuff on balance sheet, they would traditionally go all the way down the capital structure. So they're issuing all the way from AAAs down to a single B rating. I think all of the non-ADIs that we're talking about here will have the non-rated piece in these structures. So they will have that sort of skin in the game. The AAA tranches are you can almost tell if it's an ADI or a non-ADI deal from just looking at the AAA tranches, to be honest. The ADI deals are very vanilla, and they typically only have one AAA tranche, whereas the non-ADIs, because they are looking for investor diversification, and that can be across currencies, across weighted average lives, etc., you tend to find that there is a number of different AAAs. And the examples I'm putting up here is some asset managers love having very short weighted average life. So effectively it's a cash plus fund. So they will buy that, and that sort of de-risks the long. Foreign currency tranches we've talked about, different structures. So the predominant structure in Australia is a pass-through. Some of the ADIs use things like 5-year soft bullets or 1-year hard bullets in the US, or scheduled amortization, again, in the US. Given that they are targeting significant interest from non-Australian accounts, you tend to find that they are very much not about credit, so they will have multiple times the required credit enhancement. So if, for instance, for a prime deal, the required credit enhancement is, say, 5%, the minimum credit enhancement you will see for a AAA will be 10% or even 15%. And that really sort of de-risks any sort of ratings volatility on that AAA, given that there is at least 2 times CE. That then allows the non-ADI to issue potentially a subordinated AAA tranche, which is sort of an A2 type tranche, maybe single rated, to account for the fact that the rating agencies have different views here as well. Given that these assets typically are higher yielding than the non-ADIs, there is a number of cash trap mechanisms that helps to bolster some of the more lower rated notes, because you really are looking for asset managers and investors to buy all the way down the capital structure. And as you get down to single B, double B, you're taking a lot more risk clearly than you would be at the AAA level. So these cash trapping mechanisms can take many forms. One of the most common ones is what's called a reverse turbo, where it traps some of the income waterfall and actually uses it to repay the lowest rated note. Usually you have these date-based calls, which is not allowed under APRA's ADI policy. And also you'd have a lot of support facilities, so liquidity facility, extraordinary expenses, etc. Sometimes for some of those US deals, you might find that there's other facilities that sort of support some of these known amortization structures. So that's sort of a whirlwind tour through ADIs. So hopefully I've given you a view as to what the ADI sector is, why it's important, what the products that they're offering, and it really is a very wide range of products, and then how that sort of translates into different deal structures. And those deal structures are really based on the assets and the asset quality that is being originated. I will stop sharing. I will stop there, and I will pass back to Janari, or Tak. Sorry, Tak.
Okay, thank you, Stephen. I would now like to welcome Natasha Bobotic, who will take us through the next session. Natasha is the head of Australia and New Zealand structured finance at Fitch Ratings, who has over 25 years of experience in the field of structured finance. Please, Natasha. Thank you.
Thank you, and good afternoon, everyone. I'm just going to be on slide number 1. I'll just go through what my session will cover today. So during my session today, I'll be discussing the performance of the non-ADI RMBS versus the ADIs during COVID, as well as outside of COVID. I'll also look at their CPRs and any similarities or differences in the stratifications of portfolios which are securitized. As mentioned by Stephen, mixed portfolios of prime and non-conforming mortgage products have become more prevalent. So I'll go through how we assess those transactions and portfolios. And finally, as mentioned by both Ken and Stephen, macro-prudential policies have been discussed again. So I'll look at how that may impact ADIs. If we turn to slide number 2. So performance across both ADIs and non-ADIs has been strong, and there's been very little difference between the ADI and non-ADI performance since about 2015. Non-ADIs, in fact, have been performing marginally better for the last few years. And this is also a similar story for the late stage AREs being the 90 plus, as shown in that chart. Just as a bit of explanation, the divergence pre the global financial crisis was mainly attributable to low documentation loans written by some ADIs. While they were prime and mortgage insured, they exhibited higher arrears due to being written to self-employed borrowers with lumpy cash flows. And for that reason, they were more vulnerable to those interest rate movements that were seen in Australia post the crisis. Now, the volume of low docs has declined over that period, and so has had less of an impact on the overall arrears performance. Also to note that compared to pre-GFC, there's now very little low docs written, and it's typically securitized in the mixed portfolios of conforming and non-conforming mortgages. And there was no difference in the arrears due to COVID either last year or this year, as generally neither the ADIs nor the non-ADIs reported the payment deferrals they provided to borrowers as being in arrears. If we turn to the next slide, slide 3. So in terms of the performance during COVID, so during both 2020 and 2021, both ADIs and non-ADIs offered payment deferrals to borrowers. So at the onset of the pandemic last year, there was a difference in the payment deferral levels, with the non-ADIs having lower deferrals. And this was due mainly to the fact that the non-ADIs did some assessment of the loss of income due to the COVID restrictions right from the beginning. The ADIs, however, did not and granted a payment deferral typically to whoever requested it. And due to the uncertainty at the time, some borrowers requested payment holidays just in case they needed it, rather than as a result of having any reduction in their income. The drop in October was due to the APRA requirement that lenders credit assess any borrower, either asking for an extension or for a new payment deferral. And then from that point, the levels converged. And payment deferrals were less than 1% as at the March 2021 expiry of last year's deferral program. And as a result, being so small, they did not have any material impact on the arrears numbers post that date. With the lockdowns mid this year in both Sydney and Melbourne being the larger markets, payment deferrals were again offered by both ADIs and non-ADIs under the similar programs as was last year. But again, payment deferrals over this period this year were very low at around 0.6% in the prime RMBS space. And this was due mainly to a few things. So there was a build-up of savings buffers by the borrowers during previous lockdowns. Lenders were doing assessment of the impact on loss of income on the borrowers due to the restrictions and lockdown mechanisms. Government support was also announced earlier, and again, from the borrower's perspective, there was less uncertainty than last year about lockdowns and what that meant. So again, due to the low amount of deferrals, we do not expect any impact on the arrears as a result of the deferrals this year. If we turn to the next slide, being slide 4, where we look at the CPR. So again, CPRs have been split here between ADIs and non-ADIs. So historically, there's been not much of a difference between the CPRs of prime RMBS issued by ADIs and non-ADIs. And this is as a function of them writing, as previously mentioned, similar products, having similar distribution channels with both using brokers and similar borrower quality in the prime space. So with the introduction, again, as previously mentioned, of the RBA's term funding facility last year, the ADIs had access to the cheaper funding that the non-ADIs didn't. And this meant that price competition has been very strong on the interest rates. And some ADIs have even been offering cashbacks to new borrowers to entice them to come to refinance their mortgages with them. And this has seen the ADI CPR increase much more than the ADI rate. And then now that the funding facility has ended, the expectation is that the non-ADI CPR to begin to decline over the next year. If we turn to slide 5, on this slide, I've pulled together some stratifications from a selection of ADI and non-ADI transactions issued since 2018. So while the borrower balances are higher for non-ADIs, and this is more due to the higher property prices in the last 12 months being less season loans, there is not a large difference between the two in the amount of higher LVR loans being written and securitized that is greater than the 80% LVR. Investment loans and self-employed borrowers have always been higher in non-ADI portfolios, and as previously mentioned, some non-ADIs specialise in different segments of the market, such as self-employed borrowers. Interest-only loans written by non-ADIs have decreased over time, and the majority is still to investment property borrowers who take out interest-only loans for tax reasons rather than them being an affordability product. If we look at slide number 6, so as mentioned by Stephen, something that we have seen more of in the non-ADI space is the securitization of mixed portfolios as non-ADIs expand their product offering to along the credit spectrum. And with there being less LMI being used, there is less clear delineation between prime and non-conforming as there was previously, as Stephen outlined. So when we assess a mixed portfolio, we do a few things. The first thing we do is firstly look at the performance to determine if it's performing similarly better or worse than our prime and non-conforming arrears indices. And we also look at the performance at the product level, if available. We try to get an appreciation of the type of borrower who's taking out the loan with the lender being assessed to understand if the lender is in a particular segment, for example, self-employed borrowers or other. We then look at the guidelines for each product, and these listed there are some of the examples or some examples of the things that we look at to potentially reclassify some of the products. So we look at the lender's own classification, again, whether previous defaults are accepted, the dollar value, whether they're financial or non-financial, what the documentation verification requirements are, for example, and also the length of time self-employed. And some of our criteria assumptions, such as the stress CPR that we use in our cash flow modelling, is based on what we classify the majority of the pool to be. And the final slide, which is slide 7. So as mentioned by Stephen, there's been some discussions on macro-prudential policies being imposed by APRA. And as Kedden said earlier, APRA has recently increased the serviceability buffer from 2.5% to 3% for ADIs, and they may look at some other measures to supplement that or complement that. While these policies are not directly currently directed at non-ADIs, historically they've complied with them directly or indirectly. So, for example, historically most non-ADIs have used the same serviceability buffer and similar interest rate floor as the ADIs, and we expect that to continue. The other is the point mentioned by Stephen, where previous macro-prudential policies have been indirectly complied by the non-ADIs due to them having warehouses with the Australian banks, and so they get caught that way. The other thing to note is that both ADIs and non-ADIs must comply with the same consumer protection laws, and so they need to ensure that the loan is suitable for the borrower and they can service the debt. And this is ensured that there are very similar underwriting and origination policies in that, especially in that prime space, which is a major factor or one of the major factors to similar performance to date. Thank you very much.
Thank you, Natasha. We shall now start the Q&A session, and I can see a few questions coming through. The first one, okay. Maybe this is for Ken and Stephen. What's driving non-ADI prime issuance bigger than being bigger than non-ADI non-conforming issuance? Is it supply driven, i.e. as a function of loans being underwritten, or more demand driven as function of securitization investors' preference for prime versus non-conforming?
I'll have a crack at this, Takeshi, but I think Stephen is going to be better prepared to talk about the origination side of the business. From a market positioning situation, we've had the situation where the banks, through having funding options available to them, the ADI as don't have, and I would point out that deposits where the banking system has experienced growth recently, and that's the cheapest way a bank can raise money from, they haven't had to come into the securitization market to fund their loan growth to the same extent that the non-ADIs have had to do. So that's pretty much given them the market to themselves, if you like. They've had, for every $10 billion worth of available investment, more of it has been available for the non-ADIs than the ADIs, because there has been less supply of ADIs on issue. The other issue in recent years is, in a low yield environment, it tends to work better for the investor to go to the non-ADI prime issuer at the AA level than a bank, because you'll get an extra 10, 20 or 30 basis points of yield to your investment. So the combination of the banks being out of the market yield environment, that has actually worked in the non-ADI favour as a whole, prime and non-prime. Stephen, if you want to talk about the origination that supplied that.
Yeah, thanks, Ken, and I agree with all those points. I think it's definitely not driven by securitization investors. And one of the things I would comment here is there are, you've got a number of issuers there that issue both prime and non-conforming. So the investors love the prime stuff and don't like the non-conforming. You actually find some investors go the other way around, and they prefer the non-conforming assets because they're higher yielding, and any losses that come through are therefore covered from an excess spread perspective better. And also there is usually a slight premium, even at the AAA, for non-conforming versus prime. So it's certainly not driven by investors. It really is driven by what is being demanded by the borrower. And I think given what we've seen, one of the really unexpected things, from my perspective anyway, from what that happened sort of post-COVID hitting, is house prices just went up enormously. I mean, I honestly don't know if anyone would have predicted that. But because you're seeing that happen, I think then speed to markets, the speed to be able to get a loan is very important. It almost goes to the top of the list of things you need. And as I said, and I think as Natasha reiterated, you know, the non-ADI guys, they're very quick at processing here. They literally hit a button and they get all the information from the third-party providers, and that they can make an assessment very much quicker than a traditional lender. And that's really why I think the prime product is really taking off in a non-ADI space.
And I'd also add to Stephen's point in the non-conforming space, for the investor, you know, it's obvious that they're offered a lot more credit enhancement, an equivalently rated product with a much higher yield.
And I'd just like to add one point as well. I mean, Australia has had very good economic performance for many years. So the non-conforming part of the market isn't very large, which is why the non-conforming lenders have branched out to be writing more prime and near prime to expand their originations.
Okay, thank you. We have one more question, another question here. Are there any concerns around high DTI debt to income lending? And what are the fundamental weak spots in current origination macro regime?
I am happy to start that off, and then if that's all right, and I'll then let Natasha and Ken give that. It's a bit of a, I mean, people talk about the Australian market. We don't have DTI caps. I very much view that as, again, a little bit of a fallacy, because serviceability is absolutely on the one of the two major things that lenders are looking at to give a loan. And in fact, under the National Consumer Protection Act and under responsible lending, it's something that all lenders, whether you're an ADI or a non-ADI, you have to abide by those rules, because that's not an APRA thing, that's an ASIC requirement. In order to do that, you need to make sure that that loan is not unsuitable for the borrower. And typically the way that you would do that is by doing a very detailed serviceability calculation. And that really is like then taking the borrower's income, and a lot of this stuff, in fact, all of it needs to be verified. So you're looking at bank statements, you're getting notes from their employers, to the extent that they have any rental properties, you're getting all of that information. And so that's on the income side. You also then need to verify the expenses. So you're looking at current rent, if it's going to be an investment property, school fees, and there's a wide variety of expenses that also need to be verified. And then, as Natasha mentioned, APRA has then said that when you're looking at any other loans they have, or the loan you're about to take out, you need to then look at that loan, not at the current rate, but at a rate that's plus 3%. So although I think DTI is an interesting one, and I know other markets, for instance, the UK, use a DTI ceiling, I very much of the view that serviceability does a very similar job, and maybe there's an argument to combine the two and have another cap. But certainly, I think serviceability, from my perspective, in terms of what is the fundamental thing to look for in a loan from a potential credit loss perspective, it has to be loan to value and then serviceability. But that's my view. Ken, Natasha, I don't know if you've got anything.
Yeah, I think it's fair to state from the outset that we've got a regulator that is quite conservative. And And the debt to income and the loan to value tools that have been prevalent in other countries that we haven't had, or we haven't had them. So for a regulator, in terms of more capital, more liquidity, more regulation, you know, they don't say no to any of it. In terms of what the questions around weak spots, I think the regulator's current concern is based off the fact that we've had a number of years where we've had very low interest rates, and we're now at the point of record low interest rates. And they've increased the serviceability buffer on lenders so that they now actually have to be able to afford something that's twice as much as what they're facing. So that builds in a massive buffer of safety for lenders. No lender wants to write a bad loan, but we're still in this spot where the regulator is seeking more, not less. I think we can also look at history as a guide to what happens with macro-prudential in Australia. It was long considered to be not very helpful from a structural point of view. It's only short-term tools or remedies to deal with short-term problems. In 2015, we had a regulator that wanted to slow credit growth by limiting the amount of banks right in the investment space. Credit growth was already slowing relative to this, and this actually caused a big slowing in credit growth. They came back later and they chose the product that investors wanted, which was investor-only loans, and then that had another big impact in credit growth. So we've seen and that has economic impacts, and there's claims that they were slowing things down when they shouldn't have, and Tasha can talk about this. The experience of investor versus owner-occupier credit, for the last 10 years has been negligible at best. The investor loan pools have performed very well, if not better than owner-occupier. So we have a regulator that's actually done something before and has actually slowed credit growth. So I think they will be cautious and careful this time. But the fact that they've already done something indicates, I think, where their concerns lie, and their concern is if interest rates go up, how many recent borrowers are going to be hit having mortgage payments higher than they thought they were going to have. I think that's their concern.
Yeah, that's right. And I suppose the other thing to differentiate between is affordability and serviceability. So once the loan is written, and in our case, securitized, it's serviceability that becomes the important factor to look at. So to both the earlier points, making sure or ensuring that there is a level of buffer there for borrowers to be able to absorb increases in interest rates above to what they're written in, and not only for the mortgage debt, but any other debt that they also have, any other auto loans or consumer loans, or for example.
Thank you. Conscious of time, we would like to conclude today's session. There are questions coming through still, which we would like to answer individually through email. Thank you for attending our webinar today. Right after we've ended the webinar, there will be a short survey with just a few questions displayed on your screen. And we would really appreciate if you can just take a moment to provide us your feedback, which would really help us to improve our future events. Thank you again, and I look forward to seeing you at our next webinar. これで本日のセッションは終了となります。ウェビナーにご参加いただき誠にありがとうございます。ウェビナー終了後、スクリーン上に簡単なアンケートが表示されます。今後開催するウェビナーの品質向上のためお手数ですがご協力いただければ幸いです。 本日はありがとうございました。またのご参加を楽しみにしております。